Okay, well, thanks everyone for joining. Delighted you're able to make this second webinar this year that we've done. Certainly been a busy couple of months in terms of what's been happening in carbon and energy markets. So for those of you not aware or haven't discussed us with us before, we are a environmental and energy market specialist, helping across a different number of products in environmental, power and the fuel space, mainly helping with market access, risk management approaches, market and policy updates. Delighted today to be joined, as you can see, by Trevor and Ben at Energy Aspects. For those of you who joined these webinars before, you'll know their insights are top-notch, so we can certainly look forward to getting a bit of a handle on what's looking ahead. I'm going to start off proceedings by just going through some of the recent trends in carbon markets, and then after Ben and Trevor, my colleague Pierluigi will take us through the latest developments in gas and power markets, and also look at the increasingly of interest topic of power purchase agreements. And then at the end, we'll stop for some questions. So in terms of housekeeping, this webinar will be recorded. If you want a copy of the recording or the slides afterwards, please do get in touch with your relevant contact at CFP Energy. Be happy to share that. And any questions, please just put them in the Q&A box, should show at the top of your screen, and then we'll hopefully have 10 minutes or so for questions at the end of the presentations. So just getting stuck into it, a quick look at what's been happening on the policy side. The EU ETS side of things has actually been a little bit quiet recently in terms of new policy announcements, and that's sort of reflected in the market. But just a summary of kind of some of the key things that have been happening. We've got the continued rollout of the Repower EU volumes. That has been one of the factors that I know Trevor and Ben will talk about in a bit, has been weighing on prices, that additional supply that is coming into the market. It's possibly less of an impact with the recent price rally that we've seen. When we were talking about prices down near 50 euros, the expectation was for this year particularly, they would have to sell more allowances because it's not done on a volume of allowance basis, it's done more on a revenue raising basis. So the higher the prices, the less volume that has to be sold, and obviously with that less volume, perhaps less supply in the market. So that certainly has been a bullish factor that we'll talk about in due course. In terms of the free allocation, you'll be aware back in January there was a proposal in terms of looking at the new rules for free allocation from 2026 onwards. They've now been approved. They went through the 3-month scrutiny period as of the 4th of April. Still a lot of detail lacking on benchmarks, on sectors that are in the carbon leakage list, how it's all going to fit together. I don't think any installations really have a view of what their free allocation is going to be from the 2026 to 2030 period like we have already. So the actual details are yet to emerge, but one thing is clear, those free allocation levels are going to be going down across all sectors, both those on the carbon leakage list and those not on it as well. Aviation, shipping as well, will have their free allocation. Well, certainly aviation will have their gradual phase out of the free allocation, and shipping, while they don't get a free allocation, will be having increasing number of allowances to buy as the scheme evolves. Looking ahead, and generally, the focus is often the short term, but longer term, there's a continued commitment to the use of the EU ETS as the main sort of policy tool to drive abatement across the power and industrial sectors. The aim is, and certainly the Commission has recommended, the most ambitious target, a 90% reduction by 2040. And also, I think interestingly in that, there's for the first time in a long time, the mention of sort of carbon removals in terms of how we achieve that target. So ambition is certainly there. Maybe some flexibility coming into the market over the next sort of 10 years in terms of how companies can achieve that. Do we start to see the return of project-based removals into the scheme? On UK ETS, a lot of certainty remaining. We've kind of had death by consultation probably over the last couple of months. These are kind of 6 of the main ones. There are other ones that are are sort of going around, but there's been a lot of papers coming out on policy from the government looking for responses from participants on a number of factors. Again, I think the overall commitment is there for the UK ETS. The view is whether this current government or whether the future government that's going to come in post-election will be picking up many of the same policy decisions. So hopefully we start to see some clarity. We'll talk in a little bit about what that election uncertainty adds. This view of whether a potential Labour government will be stricter and tighter on targets, be more favourable to linking than the current Conservative government, is certainly one thing that's been on the minds of a lot of market participants in recent weeks, if you've been following our updates. The introduction of some supply adjustment mechanisms and equivalent to the MSR that the EU has employed over the last couple of years is certainly been talked about. Free allocation, again, quite a lot of uncertainty there. What's the link going to be with a potential CBAM? Do we start to see a phase out of all free allocation to all sectors, including those on the carbon leakage list, if a CBAM comes into place, or is it going to be a little bit more structured? And yeah, various other schemes there about the expansion to waste, and again the topic of greenhouse gas removals has come back on the agenda as well. So lots to kind of keep tabs on. Possibly the election change and the government potential change in government is going to delay a lot of this. So will we see much of the detail before the end of this year remains to be seen. In terms of the markets, what have been the key themes over the last couple of months? You'll be well aware of that big drop over the back end of 2023 as the fundamentals really took hold. High renewables, low industrial output, all contributed to a halving of EUA prices last year. Did see a rebound sort of into March and April this year, back up to current levels, sort of trading around the 70 mark, bit below that today, but that certainly seems to be a recent sort of range-bound price level that the market's got stuck out, certainly for the last month or two. Number of factors, I think, in that rebound. We hit a low of around low 50s. Not surprisingly, lots of compliance buyers who had budget available came into the market, purchasing allowance requirements for future years, both 2023 that needs to be complied with by September of this year, 2024 as well. And I think as well on that compliance buying note, a lot of companies still working very much that old end of April deadline for surrender, even though they didn't have to, getting them into their registry account ready to go. Although the deadline for 2023 surrender is now the end of September, many companies acting ahead of that deadline to make sure they, both take advantage of the low prices, but also making sure they've got everything. There was a bit of uncertainty around whether that deadline had officially been extended in some member states, but that looks to have been clarified now. And as I say, a lot of people looking ahead 2024, 2025, with prices with a 50 compared to where they've been if budget is available, that hedging. So I think that's really what started the rebound. Added to that, you had a bit of global risk factors, Middle East conflicts, Iran issues back in that March period, which added a bit of uncertainty to sort of oil and LNG markets, and that does impact onto carbon as well. So you then see the speculators start to take a view in the market, whether it was, as you'll see in a minute, a bit of a shift from maybe short positions to long positions, buying back into the market at low levels. So all of that adds to the mix of creating that short-term bull run, or that rise in prices throughout April and May. Has come off a little bit recently. Certainly the change in speculator net short positions has significantly reduced. However, as we'll hear from Trevor later, bearish fundamentals remain. So that's the overarching view in the market, and I think that nervousness about the fundamental position is kind of what's possibly putting a cap on prices rising too much. Recent high or recent ceiling's been about 75 euros. So that's certainly overarching bearish view that remains, certainly in the short term. I think is going to prove a cap on prices. And EUAs are kind of, in some respects, trying to struggle what they want to follow for direction. You'll find the market kind of drifts from a focus on the fundamentals, a look at gas, but then with other factors such as options expiry, commitment of traders data, technical levels such as daily moving averages come into play on a daily basis. You can see the market often flip-flop between different drivers and different points of focus. So quite a difficult one to sort of second guess at the moment. Volatility remains, and again, it's for those of you looking at sort of managing compliance, I think it's very much about strategy rather than necessarily trying to second guess where this price is going at the moment. As I said, less speculator influence, perhaps as those big short positions have reduced from their record highs near 40 million back down to under 10 million at the moment. But we are starting to see some of those funds rebuilding the shorts. But certainly that reduction in short positions and the discussion around whether there's a short squeeze going on and various other trading metrics around speculated positions. The weekly commitment trade report used to be a real, certainly in that kind of April-May period was a real focus. Everyone would sort of be hanging on, waiting till that report came out on a Wednesday, but possibly less so in recent weeks. UK, has certainly been a bit of a head scratcher recently. Again, we saw the market come off significantly as the policy outlook was very bearish last year. Renewables were up again, similar to the EU. Industrial demand down, so that overall bearish picture was certainly evident. We then saw this very sort of range-bound period, as you can see, where prices remain in that sort of 30 to 35 range for kind of much of Q1 of this year. And then all of a sudden, just sort of this burst of life back into the market. Again, similar story, I think, to what happened in the EU in terms of started to see some compliance buying, people looking at picking up volumes for 2024. We had the April deadline. There's no change in deadline for the UK ETS. And then we started to see this rhetoric, this story emerge about the impact of a Labour government. Would they create tighter targets? Difficult to see the substance behind it. But like a lot of things in market-based system, it doesn't always need the truth to sort of drive the market. So, certainly overall we remain bearish. The verified data again revealed a big drop in emissions. UK ETS emissions now under 100 million tons per year. Big falls in the power sector. Some falls in the industrial sector. Will they continue? I know Ben will talk about that in a bit but probably for the first time, that we've done these webinars over the last couple of years. I've always put up the commitment of trade investor positions when it comes to EUAs, but UKAs have been largely ignored to some extent. But perhaps with some of the lack of volatility and maybe lack of interest from traders in the EUA market, we certainly see it pick up in the UK market. As you can see from that plot there, marginal short positions for much of the end of 2023 second half, but started building. No surprise when we see prices get to record lows. Opportunistic buying comes in, starts with compliance buyers, but then investors naturally take a look on it. More and more investors getting comfortable with carbon as a commodity from the EUAs, starting looking at UKAs as kind of the next best thing. And certainly a smaller market, they can boss it around a little bit more. It reacts, it's a lot more volatile. So it doesn't surprise me that they're taking a greater look on this, and those positions have been built. And as you can see, they were starting to be built pre-election announcement and then continued into there. And I think that's very much a case of participants looking at the low prices in the market. And then, as the stories come out, articles in the FT and other news outlets, other traders sort of jump on that bandwagon. So hence we've sort of seen the price move up in relation. No surprise that the more demand comes in for investors in quite a thin illiquid market, trades about 1.5, 1.6 million tons a day versus over 35 million in the EU market. So again, a market that is more susceptible to volatility. Just quickly before I hand over to Trevor and Ben, I thought I'd mention the voluntary carbon market. A lot of focus we put on the compliance markets, but we also have a team very active in the voluntary markets. Certainly, I think it's fair to say it's gone through a bit of a rocky road over the last couple of years, but definitely starting to see some confidence restored to the market and a bit of a kind of narrowing down of the role that people see voluntary carbon market playing, certainly that focus on quality. And you can see how nature-based restoration credits are one of the highest prices as people move towards getting that removal credit. Again, price data is a little bit hard to come by. There's a big range in that. That peak that you can see there in the nature restoration is probably due to, in that period, there was a bit more interest in some of the higher premium products like mangrove restoration. So overall the trend is that prices are kind of holding on average around that $5 mark at the moment. A big range depending on the kind of technologies, more of a move away from avoidance to removals. But generally it's an uptrend in terms of what's happening. Carbon credit retirements are increasing, so definitely seems to be a view that confidence is coming back into the market. More participants looking at the strategy and understanding that voluntary carbon credits form a part of that strategy. They're not the be all and end all, and certainly finding a role for them in the market. In terms of that renewed confidence, it's been driven by a lot of standardization. There's various sort of standards and bodies pushing for clarity and standardization and better quality in the market. You've got the regulations that are more and more, I mentioned, how the UK and the EU at the moment are starting to look at the use of removals in those schemes. CORSIA, for example, the airline aviation offsetting scheme, is setting out the rules of how airlines can use CORSIA in this mandatory phase that we're now moving into. The EU claims codes, again, sort of setting out what is a carbon neutral claim. And then you've got the wider Article 6 discussions on an international level, which are really driving the use. We often focus in the UK and the EU on the ETS, but if you look across Asia, particularly in other parts of the world, that's where the kind of compliance role and the voluntary markets are really starting to merge together. And you're seeing a lot of the Asian countries look to more the voluntary carbon, Article 6, project to offset transfers as being the dominant sort of discussion point when it comes to compliance, as well as, so you're getting that government level buy-in to kind of the project-based market as well as those voluntary requirements. And going ahead, we talk a lot about current and future requirements in the compliance market. It's the same rings true. The analysis shows that going forward, there's going to be a shortage of carbon credit supply. So again, if carbon credits are part of your strategy, you see them as part of your carbon neutral strategy going forward, particularly for international businesses, then there is an argument to say, now is the time to start looking at trying to get some guarantee on that future supply, both in terms of availability and also price. Certainly happy to have further conversations if that voluntary market is of interest. You do just let us know. But on that note, I will hand to Trevor and Ben just to talk some more of the fundamentals of the UK and EU ETS.
No, thank you very much, Tim. Yeah, and if we can just jump to our first slide, we can really see, I guess, where we think the EU ETS kind of sits in a longer term cycle, and certainly 24 and 25 are kind of bearish markets. You don't see that much support. Tim's, it's certainly mentioned a lot of weakness on the fundamental side. We're looking at weakness coming from the power sector. We're looking at weakness coming from the industrial sector. And we're also looking at quite a lot of supply coming into the market from things like repower. So a number of things really kind of weighing on the markets through 24. That's probably going to largely continue through 25. But then we do see the move back into a bull run from 26 onwards. And a lot of that, some of that is supply driven, probably more than demand driven, and certainly has to do with things like the rebasing of free allocation, which we think is probably going to take about 18% of free allocation out of the market if we compare it to 2021 numbers, certainly for the amount of allocation expected in 26. But when you look, I guess, if we wanted to look a little bit shorter term, certainly a lot, I would say in the last 6 months, since the beginning of the year, you have seen a lot of change in pricing. We've seen some very, very low prices. We've seen some reasonably good prices. And if we went back, I guess, a little bit, all the way back into Q4. Then, of course, we did see the beginnings of this bear run start, but price is still up around 90. So we've seen prices up at 90. We've seen prices down at 50. We've seen an awful lot of volatility in the EUA market. And a lot of that, not all of it, but a lot of it really driven by speculative flows. And this, again, is the COT data from ICE. But you can see really through Q3, the beginnings of net short positions in the investment community really coming to the fore and really beginning to get big. Probably, and then we've, and kind of topped out at about 37 million tons in February, and that's when we had those low prices of about 50. Now, we have seen a number of things change, and we have seen a lot of flipping out of positions. Now, when we look at this, and we now have a quant team that kind of looks in this or does look at this in greater detail and divides these paths out into what we think discretionary traders are doing, i.e. those traders really focused on the fundamentals, and more algorithmic traders or the CTAs, which are much more kind of trend followers, much more about kind of machine-driven patterned trading. And we've seen a lot more of those come into the market. And we have seen probably those CTAs being the one flipping the fastest, so the ones really coming out of positions. The discretionary traders still reasonably bearish because of all the bearish fundamentals, but really, I think in this period where you've seen the net shorts go from, about almost 40 million tons short to being only about 5 or 6 million tons short, a lot of that was driven by that CTAs, and CTAs are actually going long in the market, leaving the discretionaries to fund some short pieces or some short positions in that market. If we go to the next slide, Tim. This now is really look kind of at the annual balances and what it does show. And what it does show is that this, for the first time probably in, since 2020, a year where we had all of, we had lots of different things going on in 2020, but certainly, of course, we had COVID that year. This will be probably the first year since COVID where the EU ETS has added back the surplus. That is, supply is going to be marginally bigger than demand in terms of the amount of supply coming into the market against what we think emissions will be. We only have it probably adding about 14 million tons, but that is, whenever you see a market that is adding back to surplus, that's not supportive at all. It is one of those things which suggests, value should come out of the market. The big question is kind of how much value. And when you look at that cumulative balance, you can see over the, it continued to fall until we got into 23, and now in 24, and expected in 25, we are expecting to see a lot flatter position, really, the market not drawing massively from surplus, not taking away a lot from surplus, and therefore not having massive fundamental direction in exactly where it should go. And as such, the market has turned to look at a lot of other things for direction and to be influenced a lot more by those speculative flows. Now, one of the things just to look at, it does look like in 24 emissions aren't going down. That's because, of course, in 24 we've added shipping as into the market. That's had two impacts. One, that's helped increase supply, of course, but it helped increases emissions. Now, if we were to take shipping out, what you would see is for the stationary allowances, the stationary sectors, both power and industry, we expect reasonably big emission reductions year on year to come from them. And again, that's one of the major reasons why we think, this isn't a year where price support is going to be particularly in evidence. Next. So looking at a little bit of a deeper dive into this, certainly when you look at exactly where this is our forecast EU 24 power balance, it has a number of themes which we saw in 23 and probably which we'll see in 25. Over the first 5 months of the year, it's already dropped by about 48 million tons year on year over January to May in terms of emissions in power. So another really big reduction coming from that. It's a mix of all the same things that happened last year. Certainly we expect pretty big increases from solar this year, The last couple of years has seen solar capacity in the EU massively increase. Over the last 2 years, we saw about 100 gigatons between 22 and 23 being added. And then in 24, it's going to be around 60 gigawatts again. So you're looking at these huge outsized increases in solar having a big impact. Hydro has also been really, really strong this year so far, continues to be strong, and probably will be strong at least all the way through summer, given generally the wetness of probably H1 for large parts of the EU. Nuclear a little bit up, but that does mean the coal and thermal is going down. A little bit of demand recovery, but not particularly much because the economy isn't doing all that much better. But big reductions in coal and big reductions in gas. Coal really getting squeezed down to almost what it can do minimum. Now we do have a modest, I would say, change of 52 million tons in our forecast, but we think that is because Q4 will actually have a little bit more thermal generation in it than it did last year. And that will come from, and what that will do is trim. We think probably by the end of Q3, you're going to look at maybe 70 million tons year-on-year reduction from the power sector, probably going down to about 50. But that is because of a number of assumptions, and those assumptions really about weather normality. So that means normal temperatures, and that's probably the biggest one. And you can see the last couple of years, when you start looking at what do you assume for the coming winters, there has been this very strong warming trend. So those are showing, of course, heating degree days at a measure of how cold it is, but the more heating degree days you have, the colder it is. Now, if you assume a 10-year average, going back, that's going to be, if you look at the rolling 3 and 5 year averages, those are much lower. We, of course, assume a 10-year normality in our assumption. So that does expect quite a cold Q4 compared to what we've had. Even in the last 5 years, it would be on the colder side of that. So there is a little bit of risk that emissions could be even softer than we're expecting based on those temperature differentials. Next slide, please. And that just takes us to, well, what do we expect to happen? And this is a nice picture really demonstrating what's happening to solar. Solar never gives you very much in Q1, and it doesn't give you very much in Q4, but boy, does it give you a lot in Q2 and Q3. So really, really big spikes in that. It does play out in a lot of negative pricing in European power markets. We've seen we have seen a really big increase in the number of hours with negative wholesale prices in those hours, just because this tends to be very insensitive to what's happening on the wholesale markets, both wind and solar. And that just means you can have an awful lot of power, and certainly on the weekends and even on some weekdays when you don't have particularly high load, all of that solar, all of that wind in the summer really can lead to those negative prices for a couple of hours every day now that we seem to be saying. Wind, if you look at wind, and one of the reasons we think probably Q4 generation is, if anything, is going to be a little bit more for the thermal. You can see that outsized increase of wind capacity, or wind generation, I should say, in Q4 last year. It was incredibly windy in Q4 23. A normal wind would probably mean you're not going to see any increase on that, just because it was so outsized, that big increase. We do keep adding quite a lot to wind as well. Certainly not as high, probably around 35 to 40 gigawatts added in 22, 23, maybe about 20 coming in 24. So adding quite a lot, again, of power. Wind does give you a little bit of a counter-seasonal balance to solar. Certainly you get a lot of solar in the summer. You get a lot more wind in the winter. That does balance things out a little bit, helps a little bit with grid stability. But, certainly these are really, really trimming load. Next slide, please. And probably the last one for me, but really, when you look at industrial production and the leading indicator of emissions and activity and what's happening there, you can see a couple of the sectors, energy-intensive sectors, actually doing okay. Refining, chemicals, pulp and paper, all having slightly higher, but that's around 2% higher year-on-year production over the first 4 months. Maybe a little bit more emissions coming from those sectors, but still those kind of building sector, building material sectors not doing very, very well. Cement, lime, and glass down about 7%, metals down about 3 to 4% in terms of activity. That does point to some, overarching, reductions in those emissions. So if anything, at best, probably you would see, a small reduction probably coming from industry in terms of its emissions. It's just not going to do very much this year in terms of year-on-year changes. It's just not improving very much. And the PMIs, the latest PMIs, the flash PMIs for June, really suggesting, if anything, business confidence has fallen back again. So we are a long ways away from those PMIs suggesting a lot of growth. And very last, the one sector that is probably increasing emissions is aviation. Flight activity in the EEA, which of course is covered under the EU ETS, up almost 6% year on year over the first 5 months of the year. So, really still strong, still a little bit higher year on year. It is beginning, to give us a bit more in the way of emissions, but it's a reasonably small sector. It doesn't really compare with either the power sector or industry. So really, when you look at the fundamentals on the EUA is broadly bearish, but it's almost balanced. It's not hugely directional, and direction really being taken and being driven by what's happening in those paper markets. And with that, I'll pass over to my colleague Ben, who will take you through our views on UKAs.
Thanks, Trevor, and thanks, Tim. So yeah, the UK market, it's been one where prices have just shot up recently. As Tim was talking about earlier, we had seen prices trundling along, in the 30s, which is £30 per tonne sort of mark, which is where we might have expected things, just given the oversupply in this market at the moment. But saw prices shoot up from mid-May. I think a lot of that was driven by speculator buying on just generally, just given this is potentially looking like a tight market in the future, but also driven by some of the potential policy stuff with the election coming up. And I'll talk a bit more about that in more detail. But generally with the UK market, we have had this period of, a large discount to EUA prices over much of 23 and much of 24 so far. That discount has come in a bit. And we do expect that, although it has narrowed, it could widen out a bit. But over 24 and 25, we do see it generally sort of narrowing to the point where, later mid-decade, EUA UK prices should be much closer together, and then we should transition into this period where UK prices should be trading at a premium to EUAs, just based on fundamentals and in the absence of linkage. And that's kind of driven by the set of balances on the right in this slide here. So we see inventory in the market still growing this year and also still growing next year, and peaking in 2025 before getting drawn down over the rest of the course of this decade, to the point where, by the late 2020s, we don't really see, any inventory left in the system, the way things are kind of going at that point. So it is looking very tight, but for the time being, we are a long way off there, and it is still, is a market where there is way more inventory than is needed to satisfy both, in-year demand and future compliance demand as well. So one that's looking that is still loose, but we have seen prices run up, and there could be some profit taking with prices having run up and things are a bit higher than our forecast for the rest of 2024, and there could be some selling by specs after those prices have risen. But we see prices rising in 2025 and going forwards as well. If we could skip to the next slide, one of the key things that has kind of been on the markets, people's minds in the market recently, has been policy, and particularly with the election coming up at the start of July, what a potential change in government could mean for the UK ETS. And I think there are a couple of factors that could be potentially affected by a change in government. So Labour, obviously well ahead in the polls at the moment. So we're kind of just looking at what a potential Labour government where a Labour government might differ to the current Conservative government on various bits of policy. So linkage is one that sort of comes up. I think one of the big barriers to linkage has been the political will to kind of push forward and link, despite kind of both sides being aware of the potential benefits of having a linked carbon market. So if there is a change in government, I think Labour would be, open to closer ties or friendlier relations with the EU, and that could lead to discussions picking up on linkage. But even then, it's something that's likely to be a long, long way away. And Labour hasn't really said much on that matter. But if those two markets link, then the price impact kind of depends where EUA prices are relative to UK prices at the time. So if we're in a situation we are now and UKs are at a discount, then there should be convergence where those two prices move together and UK prices move up towards the EUA price. But if linkage takes place at some point in the future where UKs are trading at a premium potentially to EUAs, then it could actually be something bearish for the UK market if it means prices in the UK market fall down to where they're more towards where the EU market is trading. Another policy thing potentially is unallocated allowances and the auction of those. So the sale of those allowances over 24 to 2027, that's currently in legislation that the government currently put in place. That's a big factor in our balances behind that build in inventory over the mid-2020s and that oversupply in the market. So one thing we're kind of thinking is it is a potential lever available to a new government if they wanted to try and stop the sale of those unallocated allowances. And given the election is earlier in the year than we might have otherwise expected previously, there is maybe 5-6 months towards the end of the year for a new government to try and potentially stop those sale of unallocated allowances if they wish to do so. But nothing kind of concrete at this point, just a potential option for them. Then other things they could do, changing the cap. We don't necessarily think they will, just given it's quite an ambitious decline in the cap already. On markets policy, installing a supply adjustment mechanism. We think they'll probably push ahead with that, much like a Conservative government will. But we don't see that sort of fixing the oversupply in the mid-2020s, just given by the time Assam comes in, the market's likely to be drawing anyway. And if anything, it could kind of over-tighten the market. And then various other things, we think both governments would likely push ahead with, things like a carbon border adjustment mechanism, adding new sectors such as waste, shipping, and including greenhouse gas removals in the future. So overall, I think a lot's very uncertain, given Labour's effectively said nothing on what its CCS policy is so far. But we think that a Labour government would be more environmentally ambitious than the current government. So there could be potentially some short-term bullish things on the supply side if Labour does actually decide to tweak anything. But in the longer term, short to medium term, but in the longer term, we think there could be actually this bearish story from a Labour government as well, just given they're more likely to push things that could be bearish on the emission side. So things that cut whether it's power emissions or industrial emissions by more than they would have done fallen otherwise. If we could skip to the next slide, just a bit about the timeline. There's lots going on at the moment, so lots of consultations on various topics, greenhouse gas removals, waste. There's a consultation on adding the shipping sector that's due to arrive later this year as well. I think the election probably maybe delays some of that rulemaking in the near term, just given some of the changes going on over the next month or two and this quarter. But after that, a new government or potential new government could move quicker than a Conservative government might have done. So we could start to see some real progress on some of the consultations then. But over the next few years, quite a few things on the agenda, whether it's markets policy or a carbon border adjustment mechanism or potentially even linkage or new sectors joining. If we could skip to the next slide. So I won't dwell on this too much because we've kind of talked a bit about it already, but just on this chart on the left, kind of just highlighting in orange there, those unallocated allowances that are due to be auctioned over 25 to 2027. So removing those would lead to quite a significant fall in supply, particularly in 2025, where those volumes are larger at 13 million tons, smaller volumes in 2026 and 27. Just to mention, I won't dwell on this too much either, but as Tim's talked about this earlier, but we've seen that big run up in speculator length, net length recently. And if some of that comes out, that could lead to a bit of a correction down in the market. But we have seen a lot more speculator interest in this market than we have done previously. If we skip forward to the next slide, just to touch a bit on fundamentals as well. So the verified emissions data for the UK ETS came out a couple of weeks ago, confirmed a large drop in emissions in 2023. So no big surprises there. You know, big drops in the power sector, biggest drop from industry as well, with emissions down about 14 million tons year on year. We see another kind of drop in 2024 from both power and industry again. But just one more thing to say about verified emissions. It didn't look like there were a huge amount of industrial closures leading to reductions in emissions over the past couple of years. I think that was one of the fears that, you know, with high energy prices, there could be some closures. And while we have seen some, they only amounted to about 2% of all the emissions in 2021 from industrial installations that have closed. So it's not as big as maybe first kind of feared. And that's that's one of the things that sort of came out of the data on the verified emission side. If we could skip to the next slide. So on the power side, we see another drop in power emissions in 2024. A similar sort of story, you know, power load's still pretty low in the UK and elsewhere in Europe as well. Renewables output still growing both in the UK with, you know, some new wind farms coming online now, build out of solar in mainland Europe, and that's kind of just depressing power prices in Europe and leading to high imports from Europe into the UK and just squashing that need for UK thermal generation. So that's been a factor that has been weighing on power emissions and will continue to weigh on power emissions. On the industrial side, we see another drop there. Industrial production still looking pretty weak over January to April in the latest data. Some of the PMI data looking a little bit healthier, just above 50 on the manufacturing PMI that came out. One of the big sort of sources of emissions drops that we see in 2024 and over the next couple of years is from the metal sector, though, with the closure of the blast furnaces at the Port Talbot steel plant, and that being, you know, one of the biggest, if not the biggest emitter in the UK ETS, does have an outsized impact from those closures. So that leads to, you know, a couple million tons lost over the next few years from that sector. If we could just skip forward to the next slide. I think that brings us to the end. So yeah, at this point, I will hand back to Tim.
Lovely. Thanks very much, Ben. Thanks, Trevor. Excellent insights as ever, just in terms of what's been going on, trying to get to grips with the fundamentals in the market. You know, certainly just I'll invite Pierluigi to join, you know, to talk about the gas markets, but just in terms of, you know, summary of where we're at, certainly on the carbon ETS, you know, I think it is really a paradigm shift moment, big transition ahead. You've seen all the forecasts. We are a bit of a kind of lull in prices at the moment with the recent uptake in new renewables, but certainly the policy picture remains fairly bullish, or very bullish, you could say, in the long term. Prices back over 100 with free allocations dropping. So, you know, certainly a time, I think, and I'm sure many of you are getting your heads around where's the next direction. Is it decarbonisation? Is there technology there that can support that decarbonisation? If not, you know, how do you look at the markets? How do you budget for future costs? And ultimately, I guess we're working with a number of clients is how we can help hedge that future requirement, both in terms of particularly in terms of cost of those carbon allowances going forward. So a bit of a switch of topic. There's a lot of correlation between carbon, gas, and power at the moment. So I'm going to hand over to Pierluigi just to talk us through some of the recent developments and a quick look at the growing market for PPAs as well. Pierluigi.
Yeah, thank you, Tim. So some of you might have met us at the eWorld or in kind of regular calls with us, and you know we like to have a view about things, and certainly on carbon, on UKs and EUAs, we're generally happy to share our thoughts. And those of us who have spoken to us over the last few months, we'll see that when it comes to the main calls, the big calls, we tend to really nail down the main risks and the main trends. So in gas and power markets, the trend is one of vulnerability. So I've got a couple of slides here. I'm going to talk about my thoughts on gas and power markets, and then what that could mean for your hedging requirements. So in terms of the first page, we have a chart of TTF. So the candlesticks are the front month, and the black line is sorry, 1 second. And the black line is the calendar year. Sorry. So yeah, so the two things you can derive from this chart is obviously the relative height, i.e. the price of natural gas. This is TTF. And then the distance between the candlesticks and the black line is what's known as the contango of the market. And the contango is a measure of tightness and the difference in price between the longer dated contracts in the curve and the near dated contracts in the curve. And as you can see, the volatility is substantial, which means that the view of the market changes very often, which means that if you have a flexible portfolio, it's something that we very much kind of encourage our clients to think about, because there's a lot of optimization opportunities. Clearly, we are in a moment of a geopolitical conflict, and what you can see is that production delays in, for example, in Norway, which is the last great supplier of natural gas to Europe by pipeline, have a disproportionate impact on the prices. Those are really difficult to predict. We had Sleipner off for a little over 4 days just a couple of weeks ago, and that caused a 20% rally in the market, or thereabouts 15% rally in the market just a few weeks ago. And last year with Nyhamna in June, we had over 100% rally in the front month contract over the space of 2 weeks because Norway had some unplanned outages. You then saw in October some Baltic subsea pipelines that were damaged. We then found out it was because of a Chinese ship that dragged its anchor for many kilometers, ended up ripping up this natural gas pipeline in the Baltic and kind of injecting more fear and risk premium. Then we saw a mild winter in Europe, finally melting a lot of that risk premium. But what we've seen over the last kind of 3-4 months is a resurgent bullish trend. And how do you define a bull trend in European natural gas? Typically, you do that by saying, okay, when the market shows a series of higher peaks and lower troughs over the course of two months, then it means possibly a bull trend has now been established. And what's been the driver of it? The driver is that particularly, it's been a cold European April, but especially a resurgent Asian demand is what's been really at the center of debate for natural gas. Natural gas obviously sets the price for European power by and large, so the two move in tandem. So Tim, if you can move to the next page. So what do we have here? Kind of trying to keep it simple without kind of getting too complex about it. What do I think are the main themes? In the this point of competition and vulnerability to Asian demand, Europe needs to compete for global LNG in order to fill up its storages. We had 2 very mild winters that have pretty much saved us from an even higher energy price environment. And yes, we have now built new terminals that can take ships of LNG from across the world, but those terminals don't do anything unless you can afford the LNG. So we need to be able to outbid Asian importers, particularly, not just Asian importers, of course, but primarily Asian importers. Of course, there is also Middle Eastern countries and South American countries that, and Central American countries that can also import, and they do. But the primary demand center for global energy is Asia. And a cold Asian winter or a hot Asian summer completely changed the picture. And this always happened also before, kind of from 2016, 2017 onwards, as LNG grew its market share to start impacting Europe. And now the importance has grown to a massive level. So without LNG, Europe cannot really balance itself, even with a mild winter. So what we've seen is very hot temperatures in South Asia. India has been a really big growth story. We've seen China also increasing its imports, and Japan also experiencing very high temperatures. Korea as well. They've imported more year on year. And that's pretty much translated in a kind of 1 to 2 lower injections into European storages for Q2 so far. Given that storages are very elevated levels, what you can see on the right side of the chart is our forecast for storage fill in Northwest Europe. We still expect storages to be full, mostly because we believe that Norway will produce much more than they were able to produce last year. Obviously, that remains to be seen. But yeah, our opinion is that we will receive very little LNG until probably October or certainly November. And in November, we expect some substantial amount of LNG. But price environment will need to be higher if we have certainly a cold winter, but in our view, also the base case in a normal winter, this market is fairly bullish. So unless we see a really kind of step change in weather trends in Asia at the moment, still looking extremely hot for the month of July in East Asia. So a lot of LNG burn. Coal is also getting a lot of growing demand in Asia. That's competing fuel for LNG. So clearly, if coal price goes up a lot, then Asian importers will be happy to pay a higher price for LNG. And since we need to take that a little bit of LNG, then we need to compete, and prices will need to go higher. Now that doesn't mean that time spreads need to be particularly high, and the contango still probably needs to be fairly elevated. But as a price environment, I'd say the risks remain to certainly to the upside. And while European demand has generally shrunk for natural gas and also for power, certainly European pipeline supply has shrunk faster. And we still need thermal burn to balance our energy grids. So gas will continue to remain an important commodity to set the prices of electricity in Europe. What are the other geopolitical risks? Yeah, we've talked about those in the past many times. From the 1st of January, there is a kind of widely held expectation that no Russian gas will transit through Ukraine anymore. There is limited ability or limited space to redirect the gas through Turkey and southern Balkans. So it is likely that less natural gas from Russia will be received. This EU latest round of sanctions that prohibits the Russians from transshipping LNG in European ports is probably or possibly going to be bearish, insofar that Russia certainly will be incentivized to sell more of its natural gas to Europe, but they might decide to retaliate by just reducing production, as they might have to do, given that there are logistical constraints that they will encounter if they don't decide to sell the natural gas that they're currently transshipping into Europe. And yeah, obviously, always happy to have a separate call with valued clients to dig into some of these topics a little bit more. And so yeah, so just to kind of sum up my natural gas and power view, risks remain to the upside. Europe is certainly vulnerable to shocks, and if you're not hedging while the market is quiet, which it might well be, and hopefully will be during the course of Q3, then certainly there will be a substantial vulnerability during winter, unless we are lucky to have another mild one, which is currently obviously always possible, but certainly not something that can be banked upon. Now, we prepared a couple of slides about PPAs, which are power purchase agreements. So Tim, yeah, thank you. These are something that we started trading last year. Some of you clients, you might have traded PPAs with us, but it's something that is getting a lot of attention from our client base. It is something that requires a little bit more complexity, but primarily it is something that is both needed by producers because production of renewables has been increasing a lot. And as you saw, the guys from Energy Aspects, the increase in renewables has been massive, and it will continue to be even more massive. So for consumers, this is an opportunity to buy power at a discount to baseload, as well as secure power that is physically based. Yeah, there is obviously a green effect. There's GOs that come with PPAs. And then there's many different ways in which they can be tailored to fit the needs of a client. So compared to a kind of standard baseload product. Yeah, it is something that we're certainly seeing more and more being traded across Europe. So the key markets for PPAs are Germany, Spain, Poland, Italy, UK, and France in terms of numbers of PPAs that we've seen year on year growing and in general being traded out there. And we are currently present in Germany, in Italy, in UK, and France, and in Poland and Spain we are almost set up. So please do reach out to us if you have that kind of exposure, or if you have a mandate to green your demand, or if you're a producer that needs to hedge their exposure to the increasing cannibalization, which is in brief terms the increasing effect of renewable penetration on market outturn. So yeah, handing over back to Tim.
Great, thanks, Pierluigi. And I'm conscious we're running a little bit short on time, but if Ben and Trevor can join again, we'll run through a few questions that have popped up, particularly around the linkage. Question: isn't all of this policy development on the UK is relevant? If Labour are inevitably going to link with the EU ETS, they'll lose their autonomy in terms of policy making, and how soon could that link happen? I'm sure Ben, Trevor share their view. I mean, my view is I'm not sure I can see the link really. I think the schemes are starting to diverge too much. A big barrier was always kind of who's the ultimate arbiter? Is it going to be the European Court of Justice? That's certainly something the Conservative government have never been able to get their head around. I wonder if the Labour government will be able to stretch their ties to the EU that far. So I'm kind of a view that I'm not sure it will happen. I think the UK might want to retain its own sort of control of the scheme, of its own industry, balance the carbon cuts with the various energy and manufacturing certainty that the market's there. Again, I don't know what others' view is.
Yeah, I think.
Go ahead. I guess just putting my 2 cents in, it kind of feels like I don't think leakage is that difficult, right? So in some ways, linkage is that difficult. Linkage is really just for the UK to pass a regulation which said you could use an EUA for compliance, and the EU does the same thing, and then they just work on some IT that allows one certificate to transfer out of a registry into a different registry. So in some ways, it's not particularly difficult either. Technically, I don't think the UK massively loses control over the scheme. What it does kind of lose control over is any material ability to influence price in the way that it would want to massively influence price. So to the extent it wants to do that, because of course it's tying into a bigger scheme, and that bigger scheme is probably going to have it's going to be probably the dominant price setter. So so it loses something, but I don't think it loses that much in the way of political control. Now, I guess the big question in some ways is this at all a priority for the EU? I mean, the EU still has lots of things to do in terms of emission trading that it wants to do. And of course, you are in a world where, both the Parliament and the Council has kind of shifted a bit to the right. So, I mean, I think there are questions about how much of a priority this is. And if it's not a priority, then it's going to be very, very down, low on a list of things that it might want to think about and do. Ben?
I'll just add to that point on timeline. Yeah, I think it would solve a lot of problems for both the UK and the EU when it comes to a carbon border adjustment mechanism if there is some sort of linkage in place by then. But just looking at the timeline, the EU one starts in 2026, which is a year and a half away. And these things do take a bit of time to put together when it comes to linkage, agreeing it politically, getting it passed through in law, getting all the administrative systems set up. So even by the start of the UK's CBAM in 2027, may be doable, but still a bit of a tight timeline. So it's one of those things where it's potentially many, many years away if it does happen.
Yeah. Thanks both. And yeah, I think if one thing's for sure, it's only going to be a summer of speculation about policy. Once the election result is just the start of what may come next. We're certainly not going to see any clarity probably, before September on what the direction's going to be as any new government sets out their manifesto. So yeah, I'm sure we'll be stuck with two separate schemes for a certain period yet, as Ben said, if not at least sort of 27, 28 at the earliest, would if I had to put my money on it. But yeah, well, thanks to those who stayed to the end. Apologies for running a little bit over time. As I said, if any of you want to get a copy of the webinar, ask any further questions, please do get in touch. But I'd like to thank Trevor and Ben for once again joining and sharing their insights. Certainly, if you want to get any more details about energy aspects services, do reach out to them. And my colleague Pierluigi, thanks again for your insights on the gas market, as we said, and on PPAs. If there's any more conversations that need to be had, if you want to find out more, there's a lot to cover in an hour. On the voluntary carbon market as well. Certainly do get in touch if you want to explore any of those further. But thanks again for joining. Have a good summer. If we don't speak again, we'll look to hopefully come September provide another update with a bit more clarity on some of the policy things we've been talking about. And yeah, all the best. Thank you very much for joining. Bye-bye.